and welcome to Q3FY23 results conference call of Dixon Technologies, hosted by ICICI Securities. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Aniruddha Joshi from ICICI Securities. Thank you. Over to you, sir.
Yeah, thanks, Ryan. On behalf of ICICI Securities, we welcome you all to Q3FY23 results conference call of Dixon Technologies India. We have with us senior management represented by Mr. Atul Lal, Vice Chairman and Managing Director, and Mr. Saurabh Gupta, Chief Financial Officer. Now I hand over the call to the management for initial comments, and then we will open the floor for question and answer session. Thanks, and over to you, sir.
Thanks very much, Anirudh. Good evening, ladies and gentlemen. This is Atul Lal, and we also have on call today our CFO Saurabh Gupta.
Yeah, good evening, everyone.
Thank you very much for joining this earnings call for the quarter ended December 2022. Coming to our overall performance for the third quarter, consolidated revenues for the quarter ended December 31, 2022 was INR 2408 crores against INR 3074 crores in the same period last year. That's a degrowth of 22%. Consolidated EBITDA for the quarter was INR 114 crores against INR 104 crores in the same period last year, a growth of 10%. Consolidated PAT for the quarter was INR 52 crores against INR 46 crores in the same period last year, a growth of 12%. We are pleased to report a strong performance on the margins front in this quarter, wherein the margins have expanded by 130 bits year on year. This is led by a change in sales mix, operating leverage, cost optimization, and efficiency measures across all businesses, and continued implementation of strategic price hikes across our ODM business for washing machine and lighting. Another highlight was a strong free cash flow generation post-capex of 114 crores in the first 9 months of the current fiscal. We have further strengthened our balance sheet with reduction in gross debt by rupees 223 crores in the same period, with net debt now of 68 crores, with net debt to equity of 0.06 as on 31st December 2022. We are targeting to reduce our debt by another 50 crores before March 31st, 2023, and save almost 22 crores in interest costs annually. Our balance sheet strength and enough credit lines from banks enables us to invest in long-term development of our business. Our basic approach always has been to capital policy that emphasizes on return on invested capital and financial stability. We have successfully improved our ROC and ROE to 26.3% and 28.3% respectively as on 31st December 2022, and we feel confident that same will keep improving in the current quarter and in the coming years on account of more debt reduction, working capital efficiency, and improved earnings. There is huge focus on cash conversion cycle and working capital management. Working capital days stood at positive 1 day at the end of the December quarter. Our cost optimization initiatives and proven working capital management will help us to sustain growth, profitability, and a strong balance sheet. We strongly believe we have a platform to sustain strong revenue growth moving forward through strengthening in the overall demand environment and addition of more customers, including some large accounts in mobile business. Now I'll share with you the performance and the strategy in each of our businesses going forward. Consumer electronics, the revenue for the quarter were 864 crores with operating profit INR 26 crores and 3.1% operating profit margin, which is an expansion of 90 basis points year-on-year. Year-on-year revenues were lower by 39%, led by 17% lower volumes, as Diwali was 1 month earlier last year. And also significant correction in prices of open cell in the international market. Similarly, in 9 months, despite 16% growth in volumes, year-on-year revenues declined by 21%. We have the largest capacity in India with annual capacity of 6 million sets, including backward integration in LCM and SMT lines, and catering to almost 35% of India's requirement. Our JDM business with our anchor customers is being strong, and we are in active discussion with other existing customers to offer ODM JDM solutions. We have closed the ODM sub-licensing rights with Google related to Android and Google TV, which will open up a lot of opportunities for us. 60-65% of the Indian market is on this platform. We should be able to roll out the same by Q1 of next financial year. As a part of our backward integration strategy, we will be starting injection molding in the segment for deepening our television manufacturing in the current quarter of this fiscal. We are also exploring newer products such as commercial displays used in public advertising and information displays, and interactive boards for use in educational institutions in this particular business. In lighting, the revenues for the quarter were 263 crores, with operating profit of 24 crores with an operating margin of 9.1%, an expansion of 90 basis against Q2 numbers, line what we have been making. We were able to increase operating margins through combination of reductions in input prices, calibrating pricing action, inventory planning, and value engineering. Apart from sluggish demands, reasons for lower revenues year-on-year is reduction in commodity prices, freight rates, and migration of LED technology from driver-based to DOB, that's driver on board, which are 18 to 20% lower than the earlier technology SKUs. We are India's largest ODM player in lighting and have the largest capacity in various SKUs. In LED bulb, we have a capacity of 300 million, which is 45% of the Indian requirement. We already have expanded the annual capacity in battens to 50 million and downlighters to 18 million. We are getting into new product categories like the starting strips and rope lighting, which will be launched in March 23. We'll also launch professional lighting products in the course of 23-24. Our first supplies against exports to a new customer in UAE has been executed in Q3, and we've already received the repeat orders for Q4. In Q3, we completed the technology acquisition of Bluetooth mesh technology and work in process progress Wi-Fi solution for the smart lighting from IBAN Eliminations, a premier smart lighting company. New products leveraging this acquisition will be launched in Q1 of next fiscal. We have hired Kunal Chaudhary as head of R&D from Lighting Solutions. He's one of the most experienced R&D leaders in lighting industry in India. We are also in the process of strengthening our R&D team further in the space of smart lighting and professional products. We have also started investing under the PLI scheme for LED lighting components in line with our backward integration strategy, which will make us even more competitive. The new plant for LED lighting components in Dehradun will be again operational in March 23. The capital employed in this business has been reduced to 161 crores year-on-year on account of huge focus on current asset investment. Home appliances revenues for the quarter were 244 crores with an operating profit of 25 crores, and that is 10.3% operating profit margin. The margins have improved both year-on-year and Q-on-Q, led by passing on the impact of commodity cost and exchange rate fluctuations to customers, improved operating leverage and cost optimization measures. We have 160 old models in semi-automatic category ranging from 6 to 14 kg with an annual capacity of 2.4 million. We have added more customers like Bosch, TCL, and Onida in the semi-automatic category. In fully automatic category, we have a capacity of 0.6 million with 96 variants across 6.5 to 11 kg with Bosch as an anchor customer. In addition to Bosch, we have started manufacturing for Lloyd, Chroma, TCL, Akai, Onida, Acer, and Japanese customer Sharp. We are targeting more than 100% growth in this business in the next financial year. We will be introducing more designs with new features in both categories of semi and fully automatic, and increasingly invest on making the segment more R&D driven to serve industry with the latest innovative technologies. The order book in this vertical, in this business for the upcoming quarters looks very healthy. Mobile phones and EMS division. Revenues for the quarter were 915 crores with an operating profit of 33 crores. That's 3.6% operating margins. We got some large orders from Nokia for feature phones. We are working on 2 large customer acquisitions in this vertical, which I had shared in our last interface also. We are likely to close the first account in a week's time and expecting the second account to conclude by end of the current quarter. Both these customers can potentially add almost 6,000 crores in revenues annually. We have started the construction activity in our new 5-acre integrated facility in Noida, where in phase 1 we will be constructing almost 400,000 square feet. We have hired a very senior person as our R&D head for mobile phones from branded mobile companies who will build a team of engineers and a lab in Hyderabad. Security surveillance systems, Dixon share of 50% of the revenue is 118 crores with an operating profit of 2 crores. We are going in for further capacity expansion from 10 billion per annum to 14 billion per annum, and we are relocating our campus from Tirupati to Murthy Electronic Manufacturing Cluster, where we have taken 200,000 square feet constructed facility into operational by March 23. Operating profit and margin in this business are down year-on-year in quarter, mainly due to shifting expenses and duplication of fixed cost structure. Telecom and networking products are a separate facility in Noida which got operational in December 22, and we are enforced to achieve thresholds of capex and minimum revenue in first year as per the PLI guideline. Airtel is the anchor customer and they have a strong market share in ONT and set-top boxes. We have already supplied almost 0.6 million ONT to Airtel since we started manufacturing for them. We have also bagged a very large order of HD Zapper set-top box from Airtel, and the mass production to start by Q2 of next fiscal. Also, we have done large business of Android set-top boxes in partnership with global ODMs. The development work has started in mass production to start by Q2 of next fiscal. This has potential to grow even to other geographies outside India. We are also in active discussions in this business with some other large global brands for existing and new product categories. We are also building a team for joint R&D with our partners to support our end customers from India. Laptops, tablets and IT hardware. The government is expected to come out with the revised PLI scheme to IT hardware, which is much more attractive and a higher incentive outlay. We will be participating in this PLI. Inverter controller board for air conditioners, a 4060 JV with Dixon, Japan, to manufacture these boards of air conditioners for Daikin. A new facility under the PLI scheme has been set up. The JV company is a beneficiary under the PLI. We'll make a total investment of 51 crores, where Dixon share is 20 crores over a period of 5 years, and we have already achieved the capex threshold in the PLI in the current financial year. Wearables and hearables, for both brand, we did revenue of 85 crores in Q3 and in 9 months 230 crores of the current fiscal. Presently, we are manufacturing TWS and neckbands with more SKUs like Bluetooth speakers and smart watches will be added in the new facility, which will be operational by March 23. In line with our strategy to deepen the level of manufacturing, the SMP for PCB will also be done in-house in the next financial year. In addition, we will be manufacturing TWS and smart watches for Samsung with a dedicated plant in Q4 of the current financial year. The refrigerator, we have started the construction on 20 acres of land in Greater Noida, where we are creating a capacity of 1.2 million DC refrigerator under various sizes of 190 liters to 235 liters. We have positive response from a lot of global and national brands, and we expect the trial production to start in Q2 of 23-24. I would like to now stop here, and me and Saurabh are there to respond to your question. Thank you.
Thank you. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Our first question is from the line of Bhumika Nair from DAM Capital. Please go ahead. Bhumika, your line is unmuted. You could proceed with your question.
Hello. Yes, sir. Can you hear me now?
Yeah.
Yes, sir. So the first question is on the TV segment. While there would have been some realization decline, which has led to the revenue decline, but can you give some color on what has happened in terms of volumes and how is the industry demand and, how are we seeing the segment going ahead, particularly with the Google Android license coming up, where are we seeing the customer ramp up? So that's my first question.
So Bhumika, let me share the volume numbers and I'll request Mr. Lal to answer the question on the Google and Android license. See, one of the reasons why there is a decline in Q3, one, of course, the Diwali last year was in November 1st week. This year, the Diwali was in October 24th. So clearly, the peak sales for Diwali happened in Q2 and we had a very good Q2 as far as TV sales was concerned, both in terms of volumes. So if you look at the volume numbers in Q3, this year we did 6.9 lakh TVs as against 8.3 lakh TVs same period last year. But if you look at the 9 months performance, there is a growth of 16% and we have done 26.7 lakh TVs in the first 9 months, which is a growth of almost 16% as against same 9 months of last year. Now the major reason, of course, one is of course the volume degrowth, mainly because of the Diwali impact. And second is, of course, another 25-28% kind of impact which we are seeing on account of the open sale prices coming down. So just to share some numbers on the weighted average selling price that we had in Q3 last year was somewhere around 16,000 crore, mainly because the open sale prices were higher and it's a prescriptive business to pass on in the selling prices. And now the average selling price for the complete portfolio of TV has come down to almost 11,500 rupees. So there has been a significant pricing degrowth, which has also led to revenue degrowth overall.
So Bhumika, taking forward what Saurabh has shared, as far as the demand is concerned, we are fairly confident against the volume of 2.9 billion that we did last fiscal. We should have around 20% growth in volume terms in the current fiscal. The market itself is not growing, but we're going to have this growth because of certain new customer acquisitions and a larger share of pie of some of our anchor customers. So we should be closing at around 3.5 to 3.6 million in the current fiscal, which
would mean a significant ramp up in the fourth quarter from the current levels of third quarter of 6.9.
Yeah. So responding to your question of the business opportunity on the Google side, first on the technical side, the product launch, we are targeting sometime in Q2. The trials will take place in Q1. The licensing agreements have been closed, and the various technology partners have been aligned with. In Q2, this should launch. One project has been signed with one of the brands. Please appreciate that almost 60-65% of the TV sold in India are on Google and Android platform. So we feel that over a year and a half, the opportunity pool in front of us is possibly of additional 1 million sales. That's what one is targeting through this route. The second, you would have seen the financial metrics that the margin profile is significantly expanded. The main reason for it is a step-by-step migration to owning the design. So these are two directions we are pursuing in various televisions.
Sure, sir. Sir, on the second question is on the mobile segment. We've seen a decline even on a YOY basis where we've been, at that point in time, we were kind of still ramping up the Motorola volume. While there is some decline in terms of the industry demand, etc., but it's just surprising to see such a sharp QOQ kind of decline in revenues. So if you can throw some color of, how has been the decline in the Motorola volumes per se in the current quarter. And number two, if there is a delay in terms of client additions that we are likely to add into the current quarter. We were talking of earlier, revenue of about 5,000 crores in mobiles. What is the risk to that number now? And as we scale up into the next year, what could be the risk from if there is a delay in adding any client?
So Motorola volumes have been under pressure in the current quarter, which has impacted our performance in mobile business. However, in this business also, because of huge focus on generating more efficiency and cost optimization, the margins have expanded. Motorola, we are in discussions with them how the volumes are going to pan out. And I think the next year business plan we're going to be concluding in a couple of weeks' time. They're assuring us that more export is going to come in, but let's wait and watch on that. On the new customer additions, one customer agreement, as I shared in my opening remarks, is going to close in a week's time. We are there. It's already been done. And we feel that it's going to get fructified as far as revenue is concerned in Q2 of the next fiscal. The other business that we are talking about to another large customer, we feel that it's going to take some more time. We are confident that we should conclude the other large customer's engagement also within the current quarter. As far as revenues is concerned, on the mobile side, what we are targeted for 5,000 crores, I think we should end up doing around 4,000 crores, somewhere between 3,800 to 4,000 crores in the current fiscal. Now these two new customers should add for us at least 5,000 crores in the next financial year. That's what we are looking at.
Sure, sir. And just lastly, what are the Motorola volumes in the current quarter?
In the current quarter, we are expecting the Motorola volumes to be around 800 to 850.
Okay, sir. I have more questions. I'll come back in the queue. Thank you.
Thank you. Our next question comes from the line of Aditya Bhartia from Investec. Please go ahead.
Hi, good evening, sir. So my first question is on mobile phones and lighting verticals, wherein we were anticipating an improved performance in quarter 3 when we had last spoken after the Q2 numbers. But the performance obviously has been far weaker than that. So just want to understand what really changed so dramatically, and the indications or the order book that we get from customers. Is that a very, very broad indication on which customers have a lot of flexibility to be downgrading their numbers?
So in lighting, Aditya, one, of course, the demand has been slow. The second, the unit value has significantly reduced because of migration from driver-based technology to TOB. Wherein there is a reduction in unit value of almost 15 to 18%. Third, there is always an internal reason. So it's a combination of three which has led to this Q3 numbers. Although a lot of internal work was done on value engineering, current asset management, working capital, which has led to the margin expansion to 9.1%, and we have reached the same level where we used to be year and a half back. Now the main thing is to grow the revenues. So in the current quarter, the revenue has already started touching more than 100 crores a month. So we are in the range of somewhere around 110, 115 crores a month. So we are recovering. So I think with the addition of new product portfolio and some new large customers, today Havells is a very large new strategic customer for us. We are going to be on a reasonably good growth path with decent margins in this business in the forthcoming fiscal.
Sure, sir. And on the mobile phone side, is it that the slowdown was very stark and nobody saw it coming, or is it that Motorola is changing some sourcing strategy?
So in mobile side, there has been a slowdown, and we're getting a sense of it. And the key to growth in this business is the new customer acquisition. And that's what we are working on. As I shared, that one customer we have almost closed. We're just 7 days away from signing. And another customer which we are confident about, I think we're going to close in the current quarter itself by March end.
Sure, sir. And when you speak about this 5,000 to 6,000 crore rupees of revenue potential, firstly, is that for next year, or given that we will be starting this business progressively over a few quarters, a lesser number is likely to be realized? And secondly, this 5,000 to 6,000 crores will be what proportion of the overall business that these customers may be doing in India if it's a domestic contract?
So in the current fiscal, we should close somewhere around 4,000 crores in mobile revenue. We feel that in the next year, because it's going to take certain time to launch the products for the new customers, we should be able to double it to around 8,000 crores.
Okay. And so what proportion would this, 5,000-6,000 crore rupees of annual revenue potential for these two customers be of the overall business that they do in India?
Sorry, just come again, please.
So just trying to assess the size of these customers.
Graduated shift, the potential is much, much larger. But I think first Dixon has to prove on its credentials and deliver on the committed deliverables. Then the scope is much larger. Please be rest assured.
So as I said, the opportunity is much, much larger, but initially, like the way it happens with us across verticals and across customers, it starts with lower volumes. We have to show our execution, delivery, and then gradually take the numbers increase. So please be rest assured that the opportunity size and the customers that we are working with are much, much larger, and definitely they should grow year on year.
Understood. And just one last question. These customers, this contract is mainly for domestic market, or there's an export element involved as well?
So one customer is a combine of both domestic and exports of it, and another customer is mainly domestic focused to start with.
Understood. Thank you so much, sir.
Thank you.
Thank you. Our next question comes from the line of Niket Shah from Motilal Oswal AMC. Please go ahead.
Yeah. Thanks for the opportunity. I had two questions. One is the new mobile order that we just talked about. Just wanted to understand what kind of margins will that order increment on that incremental revenue can we generate? Will it be at far more competitive margins as compared to what the blended margins of the business is?
So Niket, those margins will be definitely higher than what we are doing today because so those commercials have been partly negotiated. So and plus the fixed cost gets absorbed of the top of the team there on a much larger revenues. Of course, you need to build a bigger team, but clearly there's some kind of fixed cost which gets absorbed over the larger revenues. So you have the benefit of operating leverage also kicking in. So yes, the margins in both these customers will be much, much better than what we are currently doing.
And I'm assuming the working capital cycle doesn't change in the new order versus the existing mobile order.
That focus will always be there. Initially, yes, there can be some deployment of working capital, but once the business ramps up and stabilizes, the working capital intensity will not be there.
Got it. And the second question was, within your existing segments across the board, all the segments that you're present, as we stand today, do you think there is likely to be any downward in estimates within the existing customers, either due to slowdown or change in strategy from that customer? The reason why I'm asking this question is while new customer addition is obviously an area of growth for you, but the existing client also, when it declines, it kind of compensates for the higher growth. So just trying to understand that, one is on the new customer addition, there is clearer tailwind, but do you think within existing customers, is there any scope for downgrades? Thanks.
So, Niket, taking you through the various businesses, we shared with you that in the mobile current customers business, there has been a pressure. there has been a challenge. Taking you through the other businesses, starting with LED televisions, the current order book looks good. We are also working on some new customer clients. With the current order book also, we're going to have almost 18 to 20% growth. In washing machine, we have an extremely good order book with existing customers itself. In the current fiscal, in semi-automatic, we're going to grow from 1.1 billion that we did in 21-22 to around 1.5 billion in the current fiscal. And this trend is going to continue. We feel that we're going to have almost 15% growth in the next fiscal with the current customers itself. In the new category of FATL, obviously the base was small, so we're going to be doing almost 160K in the current fiscal, and this quantity should double in the next fiscal. In lighting business, we had a challenge, but please be rest assured, we are on an extremely strong recovery path. And month on month and quarter on quarter, we'll keep on going in our existing businesses itself in lighting. Then we have security surveillance systems. Security surveillance systems is going to have a challenge for a quarter or so because they're shifting the campus to a new site. So there will be some additional costs. And the volumes are going to be fairly steady with a single-digit growth. Then we have the new businesses. In new businesses, wherein we are in wearables, yeah, there is going to be significant growth because we're going to be adding new SKUs for both. Then in telecom devices, that is a new business we just started with Airtel, and that's also going to be high growth business. So this is going to be the trend. We feel confident about our existing businesses as well, except for mobiles, wherein we are working on new customer acquisition.
Got it. Perfect. Thank you so much, and I'll come back and you.
Thank you. Our next question comes from the line of Ankur from HDFC Life. Please go ahead.
Hi, sir. Good evening. Thanks for your time as always. So one, if you could just remind us on your top line and margin guidance for 23. Obviously, we're very close to completing the year. And also overall, any guidance for 24 on top line and margins?
Yeah, so Ankur, we did around 9,100 crore, 9,200 crore revenues in the first 9 months.
Mm-hmm.
Broadly, we should end quarter 4 somewhere between 3,000 to 3,500 crore of revenues. That should take us to broadly somewhere between 12,200 to 12,700 crore revenues. So that is a broad guidance. But I see that the margins in Q4 should also be on, if not on the similar lines, at least much higher than the quarter 1 and quarter 2 numbers. So we are hoping to close that closer to 4% kind of margins. As far as the guidance for next year is concerned, clearly we have a big growth coming in all the verticals of wearables, telecom, TV, as we mentioned, can be a 15 to 18% growth. Fully automatic washing machine can be 100% growth for us because the business just started to ramp up now. Mobile, as we had guided for, we're looking for these 2 customer account acquisitions, and this would really add to our top line. So somewhere between, I would say, next year, it can be somewhere between 90 to 20,000 crore kind of revenues. Somewhere between 90 to 21,000 crore kind of revenues. But we are in the process, in the next couple of months, we'll be doing our budgeting exercise for next year. And I'll be in a better position to share those numbers with you. But yeah, this is the broad numbers that we should target for next year.
Okay, fair. Second, sir, and not just for Dixon, but for the industry as a whole, we've been hearing of a slowdown. When we look at GSK numbers, for example, for ACs, revs, washers, the numbers which are out for October, November, and I understand the Diwali piece being slightly, earlier last year, but still, we see, single to high single-digit declines. As you said, even on TVs, we've, not seen any growth, at least on the industry side. So how are you seeing, at least for the near term? So I understand 24, maybe you, obviously because of new customer additions, etc., Dixon may see growth, but on the overall industry, if you could talk about some of the larger segments, what are you hearing from your end customers?
So I'm kind of sanguine about it.
Mm-hmm.
what you're saying is correct. So we have to keep watching and let's see how it evolves. So we can't be absolutely gumbo about it. I think it's going to be guarded kind of growth in existing businesses. In Dixon's case, what is extremely important is to run the existing businesses much more efficiently, acquire new customers, widen the product portfolio, and ensure that the new businesses that we have entered into are executed well. That's going to be the key trigger for Dixon's growth.
Right. And so, sorry, just on the lighting piece, if you could remind us, I think that's been weak for quite some time. So, and I know that's for the industry as a whole, but what's really driving that? Is it, is it that the penetration levels are high and because we also spoke about some drop in pricing. I'm sorry I missed that. So, what's kind of driving the weakness in lighting again?
So, in lighting, we feel confident that we are on a correct recovery path. We're going to have growth in value turnover. We're going to be adding new SKUs. We're going to be launching the new product of strip and product lighting in the current quarter itself. And we have built our R&D team for professional luminaires, which are going to be launched in a couple of quarters. We're going to start leveraging our acquisition on the smart lighting front. There's a lot of effort going in for value engineering and cost optimization, which has led to the expansion of operating margins from 6.7% to 9.1%. We feel that we can sustain these margins. So we feel that lighting, we're on the right track and the right steps have been taken, the team has been built to put us in a growth path. Undoubtedly, the current year has been a challenge, but please be rest assured that we're on the right path. And this quarter itself, there will be a significant recovery.
Okay, fair. And just one last one on cell phones again. And, given I think our earlier guidance was a number closer to 5,000 plus, now we're talking of around 38 to 4,000 crores for this year. And as you mentioned, right, Motorola volumes have been a little weak. But what's really driving that? Is it just their end market where they sell, things going slow? Just trying to understand a little more. And do you think that's going to come back next year, or will volumes remain low from Motorola, and therefore a lot of the incremental sales has to come from these two new customers? How should we kind of view that?
In Motorola's case, their market share in India has sustained. But what we were expecting the volumes to come from exports to US, that did not materialize. Because the global markets, particularly the US market on the smartphone side, and in Motorola's case, most of the export was to operators, those numbers very dwindled. That has impacted us. We are discussing with Motorola for next year's budget. We have not concluded the numbers. We are hoping the numbers are going to be decent. Let's see. But we have not still concluded the numbers. The other customers and new acquisition I've shared with you. We feel confident that these new customer acquisitions are going to materialize, are going to happen very soon.
I understand. Okay, sir. I understand. Okay, great. That's very helpful. Thanks. Yeah.
Thank you. Our next question comes from the line of Sonali Salgaonkar from Jefferies. Please go ahead.
So thank you for the opportunity. So my first question is, we have seen a good rebound in margins. What was the quantum of price hikes that we have taken on an average in this quarter?
So it's basically a value engineering initiative, Sonali, and also cost optimization, reducing the manufacturing cost, and also passing on certain increasing in the commodity prices to the customer. It takes certain time. We have shared with you that in ODM business there is a certain lag in that. But in the last quarter, we have been able to do that. And that has led to the increase in operating margins in the businesses like washing machines and lighting.
Got it. So in our ODM, it's still at about 30% of the sales, right?
ODM is around, in the first 9 months, Sonali, ODM is around 24% of our sales.
Okay, got it.
ODM has been a very large contributor to our profitability now. So almost 48% of our operating profits are coming from ODM business.
So last year, it was around 20-odd%. So first of all, it is 20 has moved to 24 and on a much higher revenues. So in absolute numbers, the ODM numbers are growing very fast.
Got it. And lastly, on the exports, can you quantify our export revenue for the first 9 months?
So my export revenues is majorly Motorola and a small bit in lighting. We had an export order to UAE markets for lighting business. So broadly, I may not remember the exact number, but it should be somewhere in the range of 700 odd crores, 700 to 800 odd crores.
Got it. And how much do we expect to increase that over the coming year?
So this year we should close at somewhere around 1100 odd crores. And hopefully by next financial year, as we mentioned, that we are waiting for Motorola to give the guidance on exports for next year. So that should increase the revenues for next year on export side. And one of the new customer acquisitions that we're looking for will be both for the domestic market as well as for exports. And hopefully in lighting business also we should crack some more accounts on lighting. So yes, my sense is that number should grow at a good pace. Very difficult to quantify right now. But
so my sense is, Sonali, that it will be somewhere in the range of around 2,300, 2,500 crores next fiscal.
Got it.
Let's see how the Motorola plan pans out, but that's what my sense is.
Got it. So, and lastly, you guided for rupees 8,000 crore sales in mobile phones in FY24, right?
Okay.
Thank you, sir. This is helpful.
Thank you. Our next question comes from the line of Keyur from ICICI Prudential Life Insurance. Please go ahead.
Thanks for the time. Sir, first question on the profitability of two large ODM segments, lighting and washing machine. So probably despite lower volumes, the kind of margin we have seen for Q3. So with improving trajectory, should we assume that this kind of EBIT margin or EBITDA margin are more sustainable, or probably we can improve from this margins? That is first question.
So we feel now that in our lighting, in our ODM businesses of lighting and washing machine, will be somewhere in this range only in the coming months. We feel that we are back to where we were and we should be able to sustain it. And also there has been an expansion in margins on the TV side because of larger volume to the ODM, JDM business. That also we should be able to sustain.
Okay. Second, sir, on the growth side for two segments of TV and lighting. So with TV with this addition of JDM as well as Android licensing, and on the export thrust on the lighting. So what kind of growth do we expect in these two segments? I got confused in TV since you talked about 15% kind of growth in TV. I think earlier you had guided for much higher growth. So if you can just clarify growth trajectory for these two segments.
So what one feels is that this year we should close at somewhere between 3.5 to 3.6 million, which is an 18 to 20% volume growth. We feel that in the next financial year, the kind of order book we are looking at, we should be able to have around 15% volume growth. And a large portion of it is going to be on the ODM business, and also some contribution will start from the Google kind of business, from Google kind of phones and solutions. So next year we are targeting to close at somewhere around 4.2 to 4.3 million.
Okay, got it. And on the lighting side, and just one
side,
more.
The revenues run rate had shrunk. We had a revenue run rate in the last quarter of around 75 to 80 crores a month. We are back to a run rate in the current quarter of 110 crores. We feel that we should be able to generate a growth of around 15 to 20% from the next fiscal.
Sir, just follow up on lighting. So there were two export opportunities through our anchor customer in lighting. And second is the white label export to some of the developed nations, which can be a large opportunity, more of a bulk business. So if you can divide our export opportunities in these two subcategories, and where are we in both of these journeys?
So a lot of work is being done for the developed markets of US and Europe. We feel that we're going to have breakthroughs both in LED bulbs as well as the ceiling lights in US and in Europe. We feel that these breakthroughs are going to happen in the next quarter, and the execution should start from Q3. Initially, it's going to be small numbers, but the opportunity pool is very, very large. At this stage, to put a number to it is slightly premature.
Okay, noted. Thanks a lot and all the very best.
Thank you.
Thank you. Our next question comes from the line of Gopal Navandar from SBI Life Insurance. Please go ahead.
Hi, sir. Thanks a lot for the opportunity. So my question is on the guidance. In the beginning of the year, we started with 17,000 crore and kept on reducing it almost every quarter. And even in December, when you came on the television and guided for 14,500 to 15,000 crore revenue for financial year 23, and now we are guiding for 12,700 crore kind of revenues for current financial year. Is there any way, we can just, improvise on our forecast or plans so that we have a better handle on the guidance?
So undoubtedly, we appreciate your input. But please appreciate in our nature of industry, we are a B2B company, and we are closely associated with the budgeting exercise of our customers. On the basis of their inputs, we plan our capacities and we plan our numbers. And that guidance and forecasting is prepared on that basis. However, I appreciate and your input and advice is well appreciated and well noted.
Surely. Second question is on the television segment. Is there any big revenue loss from any particular customer? Is there any big change in the volume for Xiaomi or something?
Yeah, so Xiaomi volumes have not exactly grown as per the plan.
Is that decline?
It's not declined, but it has not grown.
So Gopal, it would be flat this year. They would not have grown. Our major growth this year of this 18 to 20% growth in volume should majorly come from Samsung. And even next year, we are expecting some more volumes from Samsung because on some higher category TVs as well and some more customer acquisitions. Also led by the Google and Android license.
And do we expect any decline going ahead in the Xiaomi volume, or we expect to maintain the volumes from the Xiaomi?
Well, let's wait and watch because Xiaomi is also doing its internal budgeting. We have not heard from them for the next year's budget.
Okay.
In the next couple of months, we'll get a lot of clarity on our customer budgets, and accordingly, we will factor in our budgets as well.
Sure, sir. And on the, sir, are there any PLI incentives which we have booked in this current quarter and the 9 months, if you can qualify the number?
Yeah, so we would have booked the PLI incentive. But I can get back to you. I would not be remembering this number, but I can get back to you after this. A small number, it would be somewhere around 8 to 9 odd crores broadly.
Okay. And sorry, I'm not sure whether we already discussed on the export side on the lighting. Because I think the commentary in the past has been there are large opportunities and we are very close on some orders. If you can just give some color on that lighting exports.
So as I shared that business with Middle East has already started.
Okay.
I've executed the first order and the repeat orders have started pouring in. So we have a consistent business from the Middle East market, and we are in final stages of negotiation for US market. We're expecting some breakthroughs in March or early next quarter, and the execution will start from Q2 of next year.
And if I'm right, we said that the customer which we are concluding in the coming week, the revenues will start from Q2 of next year.
That's right.
So in that case, the whatever like revenue or projections or estimates we have for next year, it will be back-ended.
That's right.
Sure, sir. Thanks a lot for this opportunity.
Thank you. Our next question comes from the line of Girish Achhipalia from Morgan Stanley. Please go ahead.
Thanks for the opportunity. So, sir, in the event that you are able to close the customer in next 1 week, and it probably takes slightly more longer time for the second customer on mobile side, what could be the incremental revenue be from this customer that you close in the next 1 week, approximately?
So it's going to take some time to ramp up, and that's what I indicated. That in the current fiscal, we'll close the mobile revenue somewhere around 4,000 crores, because it's going to take some time to ramp up in the next fiscal with the additional new customers, and expecting Motorola revenues to remain almost the same, and we should double that to around 8,000 crores.
No, my question was if you are not able to convert both, but at least one. So the first one, which is likely to happen sooner, in that situation, what could be the
customer one should generate next year around 1,000 to 1,200 crores because it will start around Q2, and the customer two will generate around 2,500 to 3,000 crores.
Understood. And then, sir, just in terms of capex, what is the outlook for this year and next year, please?
Yeah, so Girish, this year 9 months we have done a capex of almost 280 odd crores, and broadly we will do another 80 to 90 crores of capex in Q4, mainly for a refrigerator project. So we should close this year around 360 to 380 odd crores of capex. I think the plans for next financial year are getting made. I will be in a better position to guide by the month of March. But broadly, it should be lower. It should be lower than what we have done this year as well as last financial year. But so my broad sense is it should be in the range of 200 to 250 to around 250 to 260 odd crores.
So capex would be lower despite two mobile customers potentially getting added?
Yeah. So those customer accounts, the asset turns are significantly higher. In terms of capex investments and all, it will not be that much. So mobile is one business where the asset turns are significantly higher.
And if you could put some color around margins for mobile business, I think it was stronger. So how does this kind of continue into next year? Given that you are looking to add
9 months, the mobile and EMS business, of course, has done around 2.8% margins. Of course, if I remove the EMS business, the mobile margins would be somewhere around 2.5, 2.6%. Of course, the customer accounts that we are talking for next financial year should come at a slightly higher margins based on the broad commercials that we have and we will be agreeing with them, and also the operating benefit. So yes, this margin should inch up by around, if not more, by at least a 25-30 basis year kind of an improvement next year on the mobile business.
And this higher margin is driven by lower PLI being given or shared to them, or is it some specific operating leverage or ODM capability or backward integration that you are targeting?
So it will be a combination of commercials, including your NVA that you charge on the customer, to the customers, I said, and also the benefit of operating leverage benefit will lead to margin expansion on much higher volumes. And third, what I can say as of now, Girish, those commercials as compared to our existing portfolio will be slightly better.
What is the bill discounting number, last question, at the end of this quarter, and what is the rate of interest?
Number was around 130 crores.
And what is the rate of interest that you pay on the bills discounting?
It's somewhere around 7.5%, 8%.
Okay. Thank you.
But a lot of our interest cost, Girish, is also on account of the India's adjustment. So of the 15 crore interest that you are seeing for the quarter, 4 crore is on account of the India's adjustment. The rental premises that we have taken, that gets bifurcated between depreciation and interest. So that's more of an accounting entry.
Thank you. Our next question is from the line of Amber from Nipping Mutual Funds. Please go ahead. Amber, your line is unmuted. You could please proceed with your question.
Hello, am I audible?
Yes, sir.
Yeah. Hi, sir. This is Amber from Nippon Mutual Fund. Just two questions from my side. Is one, this year we have seen two major segments have seen a significant cut on the realization. One on the TV side because of open sales, and then now lighting where because of the change in technology. So going forward in all the segments where we operate, do you see anywhere where any change in technology is taking shape, which can lead to maybe realization decrease going forward because of efficiency improvement and all? Any of the segments where we operate, we are seeing any such a potential technology change which can lead to lower ASP?
So as of now, no.
In fact, it should get better only because a fully automatic washing machine, which is at a much, the realizations are much higher than the semi-automatic. Those volumes would grow by more than 100% next year is what we are targeting. So clearly the realizations should only go up, and we don't foresee any kind of a thing which has happened in open cell on account of open cell.
And even in televisions, there is a small increase in prices of open cell now. And also the pricing of the LED lighting products has kind of bottomed out. I don't see any further reduction happening in the unit values there.
Mm-hmm. Okay. Secondly, sir, if you can give some color about the progress and numbers on the IT hardware, which is tablet and laptop side, how the tie-up with Acer is progressing, what kind of numbers we are doing, and outlook on that line. And also, along with that, if you can give some color on, is there any opportunity for Samsung smartphones as we are now, as they're moving out of feature phones? So on the smartphone side, can we get any volume from Samsung on that line?
So on the IT product side, we were a beneficiary of IT PLI scheme. We achieved both the capex and the revenue threshold. And our anchor customer there was Acer. We continue to manufacture laptops for Acer. But now the government of India is coming out with another PLI scheme, which is much larger in purpose and much more attractive. We're expecting the new PLI scheme in IT hardware to be rolled out in next 30 to 45 days. We will be participating. And Acer is always there as a customer. We are also in dialogue, in discussion with some other large global brands. So we're going to be participating in the new PLI of IT hardware. For Samsung, we are already doing their 4G and 5G phones. In fact, this month itself will be doing more than 1 million a month.
Okay. So just to follow up on this, is if you can give some color on the numbers in terms of laptop this year and next year you're targeting. And secondly, whenever this new IT hardware PLI gets rolled out, so will we get automatic qualification for the same, or do we need to apply again for the